how the real estate industry is under assault by Opendoor. Welcome and thanks for coming back to the channel, folks. This is Jason, certified financial planner and host of Fighting Words Financial. Today I'm using my new camera for the first time and I'm using new software for the first time. Everything's new except for the microphone, but I'm upgrading that soon too. But today I wanted to talk to you guys about the real estate industry and how Opendoor, a company that ARK Invest has recently been very interested in, and many other property technology companies might be positioned to disrupt the $20 trillion US residential real estate industry. And all I have to say is it's about time. It's time for disruption. This is a really antiquated industry in a lot of ways, and they need to be dragged into the 21st century, kicking and screaming if they need be. Now I can already hear people, realtors mostly, furiously typing in the comments about all the digital stuff they do, but to be honest with you, that's just window dressing and the real change is coming. And it's also time for you to hit the like button for the almighty and mysterious YouTube algorithm and to subscribe if you haven't done so already. Lately, I've been starting off my videos by kind of laying out my biases and giving my opinion up front and then presenting my mostly neutral examination of the company and hoping that you stick around for the rest of the video. So here's the bottom line. I didn't really have that much of an opinion about Opendoor before I started this research because I've never used their service, but I've been involved in the real estate industry for a long time, and I mean as a buyer and seller of real estate. And to be honest with you, I find the whole process of buying and selling property to be enormously frustrating. So when I started looking at this entire digital space with real estate, Opendoor really isn't my favorite company in this space. It doesn't mean that I don't like the company or I don't think they're going to be successful. They do have a good business model. They have excellent leadership and really solid financials, but they do have a lot of competition and they are years behind some of that competition, some of those really big players in that space in terms of vertical integration of their business ecosphere. However, I think that if you stick around to the end of the video, you're going to see why those things really don't matter and why there's probably nothing standing in the way of Opendoor becoming enormously successful in the future. It all comes down to the massive addressable need of mostly real estate sellers. Most of the financial burden of the transaction falls on sellers, and sellers want to reduce costs wherever they can. Opendoor, Zillow, Trulia, Offerpad, Redfin, and a whole host of other companies are stepping up to make that happen. Despite the size and complexity of real estate, it's really a fragmented market and a frustratingly large part of the behind-the-scenes work of buying and selling a property has remained really steadfastly analog and unnecessarily complex and expensive. There are a stunning amount of practices and people involved in a real estate transaction that simply don't make sense anymore, and maybe they never really did. You know, as someone who frequently has moved in my life and I purchased several primary homes and several rental properties, I've encountered a lot of practices in the industry that simply boggle my mind. And whenever I ask for an explanation as to why this process exists or why I needed to fork over my hard-earned cash for some apparently useless or really expensive or wasteful practices, my questions were usually met with blank stares and what can only be described as smug hostility. You know, the sort of, you just don't understand what's going on. So this happens so frequently that I realized that most of the practices that really annoyed me were simply done that way because that's the way it had been done before. Kind of like on Tesla's battery day, the way Elon Musk described battery manufacturer, they're only doing it this way because that's the way it was done in the past. So the real estate industry, like many other industries, is a conservative one that's been very slow to embrace change all on its own. You know, sure, they've adopted the trappings of technology. You have website listings, virtual walkthroughs, online lead generation. But the industry really hasn't done a lot to streamline the enormous amount of people who are involved in a real estate transaction between a buyer and a seller. And all of those people, of course, have to be paid. So here's just a partial rundown of who might be involved in a typical real estate transaction. You have the seller, the owner of the property to be sold, the listing agent, the listing agent's broker, the buyer, the buyer's real estate agent, the buyer's agent's broker, the buyer's mortgage lender, which usually includes a loan officer, a loan underwriter, a loan processor, and an actual lender, you know, the person who actually gives the funds. Then you have the escrow officer. This person usually leads a whole team. Who knows how many people are on that team? They're in charge of documents, funds, contract, HOA, and closing documents. Then you have the title officer. This is a whole second team of people in charge of liens, previous insurance claims, and recording the deed. Then you have the appraiser. Sometimes you have a termite inspector, a physical inspector, a home insurance agent, and sometimes a home warranty company, and almost always a notary. Every single one of these people that is involved in a transaction that's really between a buyer and a seller has their hand out and does expect to be paid. I'm sure that every one of these 19 to say 30 to 35 people involved in a real estate transaction probably thinks that their job is necessary and secure. But I'm telling you folks, just like switchboard operators, bank tellers, and carriage makers, I'm going to say that your job probably isn't secure because change is coming, and a lot of these people are going to be financially cut out of real estate transactions in the near future, and their jobs are probably going to be rendered obsolete. The benefit to society is that the process is going to be streamlined in a way that benefits buyers and sellers and not agents, brokers, and the various other professional officer types that are involved in a real estate transaction. Opendoor is leading a technological and machine learning enabled charge to cut out agents, appraisers, and brokers out of real estate transactions. And I think that if Opendoor isn't ultimately the next Tesla of real estate, the streamlining of real estate transactions is going to happen anyway, and it's probably going to happen fairly rapidly and more rapidly than we expect. So let's take a look at Opendoor. Whenever I make my first pass at company analysis, there's usually four main factors that I like to take a look at. And folks, this is a first pass analysis. This is a company worth tracking, and I'll be following up on this company. They've got a lot going on, and they have a really complex business model, and this is just a surface pass over there. So let's look at the four main factors. I like to look at the business model, the leadership, financials, and what sets the company apart. So let's take a look at the business model first. In the simplest of terms, the Opendoor business model is dual faceted. One side involves buying homes from sellers and flipping them. And the other side is a business unit that provides brokerage services to customers that want to buy or sell a home, and it's all done through a mobile app. The focus of Opendoor is concentrating on providing benefits in the form of lower costs and process streamlining to sellers as they are the ones that really pay the majority of fees in a real estate transaction. Opendoor's mobile app allows people to buy and sell homes with just a few clicks and without the need of a real estate agent or broker, and consequently without the need to pay them. Opendoor handles the evaluation, inspections, closing, title, escrow processes, financing, home services, and they are even planning to go into the insurance business soon as well. I think one of the biggest benefits, and the one that probably takes a lot of the pain out of the process, is that the whole process of closing is digital. If you're a seller, and let's say I may be biased here because I've done a lot of selling of real estate, and that's always been a lot more unpleasant than buying. You can begin the process of selling your home with a few clicks, and I find that to be enormously simple. You can tell Opendoor about your home and instantly see an estimated value. It's a free process and it doesn't come with any obligations. Opendoor is going to work with you to schedule a convenient virtual assessment of your home, and after that they're going to share a final estimate with you and make you an offer. At any point, you can actually back out of this process with no penalties or anything like that. And a lot of their competitors actually have penalty fees. Opendoor is able to provide almost near fair market value estimates for homes using a proprietary valuation model that leverages machine learning, artificial intelligence, and human review. This probably deserves a video explanation all on its own, as it's a major part of their business and really one of the core technologies that drives cost declines for the consumer and for revenue growth of Opendoor, but I'm not really going to go into that today. At that point, you'll have the option to sell directly to Opendoor for cash or to list through them with an agent. A surprisingly large amount of people are opting to take the cash offer, and that feeds directly into the flipping business, which is part of their core model. They also have an enormous conversion rate for leads that come through the website, up to 36% from some estimates that I've seen. I should mention, though, that when it comes to flipping, their margins are somewhat thinner than a traditional house flipper, but so are their costs. Opendoor has what essentially amounts to wholesale discounts on repairs due to the volume of business they have and the partnerships they forge. They make money by collecting a service charge instead of agent commissions. It covers the cost of buying, maintaining, and eventually selling your home. The service fee is currently no more than 5%. They do say, though, that that is subject to change. There are other fees possibly involved depending on repairs and how long it takes to sell your home if you actually choose to list with them. But it's actually way cheaper than going through a traditional broker. And when you receive an offer, you can choose to take their immediate cash offer from Opendoor themselves, or you can list it and put it on the market, and you know exactly how much your fees are going to be. One of the many reasons that many people are choosing to take the Opendoor cash offer is that there's no staging, storage, or prep costs when you go to sell your home. It's over and done with pretty quickly, and the whole process is simplified. They give you a competitive all-cash offer based on the features, the condition of your home, and current market trends. You also don't have to worry about things like seller concessions. This is always one of the most annoying things that I found about selling a home. All of those annoying little things that you have to do that cost you, the seller, money in order to sweeten the deal for the buyer. You get the certainty of a competitive offer with Opendoor without having to go through the offer and counteroffer process. Now, the final and really huge benefit of the process is the limiting of home ownership overlap costs, which can actually be pretty large. And I experienced this once, and it was a real surprise. And I'm going to say that I didn't enjoy that surprise whatsoever. A big part of that is that you get to choose when the deal closes, and it limits the time that you might be responsible for two homes. You know, timelines almost never align perfectly, and many times there are costs for things like temporary housing or months where you might be responsible for two mortgage payments. You may also need to pay things for like storage fees for all your stuff, extra moving costs, or you may even have to go back to the new owner and negotiate some sort of leaseback arrangement for the transition period. So even if you are able to align your timelines, there's still going to be holding costs for the days that you have your old property, like partial mortgage payments, property taxes, prorated HOA fees, utilities, insurance. According to Opendoor, those costs can typically add up to about 1% of the total sales price, assuming a transition period of about 1.5 months. So this is just a brief look at their business model, and it could certainly use a more in-depth examination, especially when you're looking at comparing the costs of going through Opendoor versus a traditional broker. Based on what I saw, it's a lot cheaper to go with Opendoor, and I think that I'm going to use either this service or a similar service the next time I decide to dispose of one of my properties. But in the interest of brevity for this video though, let's move on to leadership. I'm certain that I'm going to leave someone out of this part of the video, and for that I apologize in advance. But Opendoor was founded in early 2014 by what can only be described as a group of entrepreneurial and tech gunslingers. Eric Wu, Keith Rabois, and Ian Wong. They're like some sort of modern day Magnificent Seven, or, in homage to Akira Kurosawa's Seven Samurai, except there's only 3 of them. They didn't have any trouble raising initial capital. Keith Rabois is a high-profile venture capitalist at Coastal Ventures, and he's a former executive at PayPal and Square. Eric Wu was the founder of Movity? That's a real estate startup, and it was actually sold to Trulia at some point, so he's got experience in this industry. And Ian Wong is their machine learning expert, and he was also the machine learning expert at Square and Prismatic. And if we take a look at who's in their leadership circle today, this is a team with deep experience in technological innovation and deep experience in conceiving the ideas that upended other industries. Suffice it to say that I don't have a problem with the leadership of Opendoor in any dimension. The financial condition of a company is the third thing on my list, and something that you should always take a look at, but it's actually kind of tricky with a company that isn't yet public. First, they don't really have any of the stringent reporting requirements placed on them yet by the SEC. And second, because Opendoor is going to list via merger with Social Capital Heliophisia Holdings 2, which is, man, that's a SPAC with a really long name. SPAC is Special Acquisition Corporation, and I'll put the ticker symbol in the description. Some of the filings and disclosures that are normally associated with going public simply aren't necessary if you're going to merge, and maybe I should do a video on what I see as an eventual SPAC massacre in the market, as there's entirely too much enthusiasm for most of the companies that are going public in this manner these days. But here's what we know. Based on the filings and the information that Opendoor has voluntarily released, Opendoor is not yet profitable, which is common with growth companies that are pre-IPO. Company financials show that Opendoor lost $218 million in 2019 after losing $131 million before interest, taxes, depreciation, and amortization in 2018. Opendoor has a wider projected loss of $141 million this year, and during an investor presentation in September, Opendoor said that the company expects to turn a profit by 2023. Analysts and experts appear to take them at their word. And here's one of the reasons why. If you look at this graph of revenue growth over time, it certainly looks like profitability can't be that far away. Revenues have grown from just $700 million in 2017 to $4.7 billion in 2019, and that's only on sales of 18,799 homes through their app in 2019. The reason that most analysts take them at their word is simple. Prior to the pandemic, virtually every industry that can move sales online had already done so in earnest, really except for real estate. Real estate sales are really just the very early stages of its digital transformation, with less than 1% of sales happening through a digital experience. There is a giant addressable market. The addressable market, the people who can benefit from this digital sales experience is actually inconceivably massive inside of the United States, at least. If you look at just the first 6 markets that Opendoor has been in, and these are the markets they've been in the longest, at least since 2016, for Q1 of 2020, their run rate revenues were $2.7 billion just in these first 6 markets. That's with their market share only being 3.2%. And that's really small when you think about it. But they're actually in 21 markets now and currently have an even lower market penetration rate of around 2% when you look at all their markets as a whole. The run rate revenues as of Q1 2020, prior to the pandemic, were projected to be $5 billion. These numbers would have been impressive had there been no pandemic. Right now, however, end-of-year projections have Opendoor coming in somewhere around $2.7 billion in total revenues after laying off about 35% of their workforce in April. So far, I've thrown you a lot of numbers without a lot of context. So let's take a look at how this translates as the company matures and they expand into new markets. Over the next 5 years, Opendoor is planning to expand their offerings into 100 different geographical markets and to expand into the high-margin insurance business. I suspect they'll probably make that expansion into the insurance business by acquisition rather than trying to start a company on their own. Based on a market share capture of a mere 4%, Opendoor is projected to have $50 billion in revenues. So if I bottom line it for you, based on the available information we have about their finances, there isn't much that makes them stand out in a negative way when I compare them to other pre-IPO companies, and really the situation looks pretty positive. They have quickly growing revenues. Yes, they aren't profitable at this moment, but a pre-IPO company rarely is. Their revenue projections really do make them stand out, of course, but take those with a grain of salt. The most important thing that I found about this deep dive, though, is the sheer size of the opportunity, which brings me to the final point that I want to consider when making a first pass at company analysis. What sets Opendoor apart? What makes them so different than their competitors? What is the moat surrounding their castle, and what gives them that clear advantage? As much as I wanted to find something, I really couldn't. As always, there might be something that I missed in my analysis, and I welcome you folks pointing that out to me in the comments below. But I really didn't see them doing much that their competitors aren't doing, and most importantly, I didn't see them doing anything that their competitors couldn't do. But here's the thing, I don't really see any of their competitors making an impact on their business in the near term, because they won't actually be competing against other companies in the digital space for years to come. They're really going to be competing against traditional brokers and stealing market share from them for the foreseeable future. And it's going to be years before we see Opendoor go to war with the likes of Zillow and Redfin. So because their business model looks solid, the market is huge and in the initial stages of a digital transformation, they have a solid leadership team, and the financials are exactly what I expect for a company at this stage of development. I just don't see anything standing in the way of their near-term success, say over the next 3 to 5 years, and I certainly think that they have a shot at being a dominant player in the future of the real estate industry for the long term. So there you have it, folks. This is just my opinion. I know that there's a lot about this company that I didn't cover, and I'll try to get to it in my next video. Please don't accept this as any instructions to buy, sell, or hold any securities. This is not financial advice aimed at any individual. This is for entertainment purposes only. Feel free to contact me and tell me how wrong I am in the comments below. I look forward to seeing you guys next time. Thank you.